went through and gave us some examples of how you thought that speculation limits ought to be set and for various categories, and that was helpful. I would like folks to know that annually there are about 6.6 billion trades in the futures and options market, and about 10% of those, or 11% of those, are in the energy area. Again, picking up on Mr. Cicero's testimony, for us to be able to do the types of things that are being advocated would be very, very human and fiscal intent. Would be tremendous, and I want people to know that, and I would ask you, are you willing to pay a fee, a transaction fee, to ensure that you've got that type of oversight?
Wanting to? No. Willing to? That's a hard one to answer. Certainly we don't want to, but certainly within reason we understand that that possibility exists. A small fee maybe. Willing? Yes. Wanting? No.
That was such a great answer. I won't ask anybody else that question. There's been a little banter back and forth about the types of data that is included in whether or not conclusions are based on empirical data. Ms. Graham, you said that spec limits is the only other variable. Mr. Cicero, you said it was common sense. Later on, we're going to hear from a panelist that says a good part of this is a result of environmental regulations. Did you, too, take that into consideration when you looked at your testimony?
I would, as you raise it, that's an interesting question to think about. Did I take that into consideration? No. You know, the impact of ultra-low sulfur diesel, biodiesel. It's a good question. I didn't think about it.
No, sir. I'm sorry. We didn't consider that.
Thank you, Commissioner Dunn. Commissioner Summers.
Thank you, Mr. Chairman. My question is for Mr. Ciccio. In your written testimony, you state that you believe the CFTC has the existing authority to implement position limits, and I was just wondering if you have a view on more specifically how we would impose those limits on the OTC market. Whether or not we use our information through the special call, how you impose limits on swap dealers, on the ultimate end user commercial hedger that may go through a number of different swap dealers, if you have any views on those complexities.
Thank you for that question. We have not sufficiently put pen and paper together to address the details of those important questions. So unfortunately, I can't answer that question. They're all the right questions. And we had assumed that after these hearings there would be opportunities driven by the CFTC asking those specific details for us to respond to. Sorry.
Question for Mr. Graham, and this goes back a little bit to what Commissioner Dunn was asking you about your specific views on how to impose these limits, and you did give us some very detailed recommendations on your views, but one of the views is that the swap dealers and market makers position limits should rise and fall depending upon the trades they exercise for their clients. And I'm just wondering if you could elaborate on how that would work for either their commercial clients, their own internal book, how we would do that.
Our position would be for the swap dealers who are in position to support commercial participants, whether a trucking company is adding trucks, growing the size of their fleet, other fundamentals that would increase and decrease the amount of product they actually consume. We want the flexibility, want the swap dealers to have the flexibility to increase, based on those market changes. I think that's all that I was trying to say with that. We don't have a steady need at all times. Our business goes up and down, and we just want to be able to flex up and down. And so to the extent the swap dealers are working with a participant who consumes the product, they need to increase and decrease those amounts.
Just as a follow-up there, I want to make sure that I'm understanding this correctly. So you think that the position should be imposed on the dealer, not looking through to the end user? Or are you saying that the end user's need or limit may rise and fall?
I think the end user's limit may rise and fall, and if the third party, if the dealer that they're working through is acting on their behalf, then they would be able to rise and fall the same amount.
Okay. Do you know if trucking companies and members of ATA, if they use a number of different dealers for their business? And I'm just wondering how that would work.
I know that we do, so I would believe it would be safe to assume that they would as well.
And so how would that work? If you're using a number of different dealers, how does that work if we're imposing the limit on the dealer?
I guess that gets into the reporting requirements and the transparency requirements that before I dig myself into too much of a hole, I dealt with, from my perspective of having to buy and to explain to customers why prices go up and down. Some of my written contributions were about the realities of what happens, the how-to. I must admit, I don't claim to be an expert in that area.
No, that's okay. Thank you. I appreciate your views.
Thank you, Commissioner Summers. Commissioner Chilton?
I had a question for Mr. Graham, but in your testimony you talk about how 1 cent equals $397 million to the trucking industry, 1 cent increase in diesel. And I want to highlight that only because what I was saying earlier about even if there's just a little impact, that it can have a big reverberation in individual sectors of our economy and in the aggregate. So thank you for that. But Mr. Graham, with regard to position limits, do you think there ought to be additional categories beyond the commercial and non-commercial categories that we currently look at?
You might want to push the button there. Thank you.
At the risk of being difficult or not having good knowledge of the breadth of the topic, as a trucker who has to buy the fuel, we're very sensitive to price volatility, probably more to the volatility than the absolute price as it goes up and down. And there are probably other users who have legitimate needs that I'm not aware of. I try to represent our industry and probably don't have the breadth to represent others.
You're doing a good job. Mr. Ciccio, since you support aggregate position limits, do you think traders in other physical commodities like metals, and I know that's not your particular area of expertise, but generically, do you see a reason why we should treat them differently? And a follow-on to that is, do you think there's a difference between the physical and the financials? Should we be looking at them all the same? Are there important things that distinguish them each?
The futures market is about supply and demand fundamentals of a given commodity. And so these basics that we've been talking about should apply to all futures markets, metals included. The question on the financial organizations, I mean, everybody is every transaction, every player is linked in market dynamics, and so we need the same rules of the road that apply to all players. The key here to making this market work the way it's supposed to is ensuring that each transaction, when we get to this issue of exempt financial transactions and without position limits, I think we've been too lax in giving exemptions away that are not necessarily tied directly to the underlying commodity, and that has caused a big part of our problem. So everybody needs to be included with the same rules of the road.
Thank you. Mr. Harlan, I got back to what the chairman was asking about disaggregation of funds, and I realize you have a parochial interest, and I respect that, and good for you for having a thriving business. But why would it be a bad idea to have more competition in these markets? I know you're not going to be able to take your hat off, but if you can just a little bit, why would that be a bad idea to have more competition in these markets?
Aggregate liquidity in the natural gas, crude oil, whatever your market is, will drop, which will increase price volatility. That's the simple answer.
Yeah, but you said that somebody else would pick it up, either your competition or you'd make it into 4 funds, so the money would still be there. I guess it's not this. If you have 4 funds and they're all yours, it's just
actually aggregate liquidity would still drop. Look at it the other way. If you have 4 pools and each has X amount of liquidity, and then you combine it into one pool, you don't have 4X liquidity, you have 8X liquidity or 12X liquidity. As I referenced in technology, this is known as Metcalfe's law, and I'm sure one of the academics can probably give you a similar name for this function. So as you fractionalize it, liquidity goes down, volatility goes up. Whether that actually changes the ultimate price outcomes, except at the extremes, is a more difficult question. Clearly, the behavior over the last 2 years of the passive index funds have been to dampen the volatility because we were net sellers while prices were rising and net buyers when prices were falling. The more you interrupt that, you're just buying yourself more volatility and less liquidity, and that's going to be probably a bad thing, I would think.
Thank you.
Thank you, Commissioner Chilton. With the patience of other panelists, at least the chairman has some more questions, so we might end up with I think we're going to have a third round for any of us, but it will be the last round. And with the patience of Mr. Graham and Mr. Ciccio, I do want to come back to that, what you were just talking about with Mr. Chilton. I think we have a difference, you and I, in terms of liquidity. I'm not familiar enough with the law that you just said in technology, but what you're suggesting is if one party internalizes the extreme, the whole market, there would be more liquidity. I don't think so at all. I think if one party, whether it's a hedge fund, whether it's a large financial institution, or even an exchange-traded fund, internalizes all of that liquidity, then the tens of thousands of other users don't get to see the bids and the offers. They don't get to see the marketplace, and there's not competition. We could say that the auto industry would be more efficient if there was only one auto supplier, or the trucking industry would be more efficient if there was only one trucking company or airline. We could, and somebody might say that, and they might even quote some law in technology. But in markets, which I've been around for my whole adult life, I believe that competition in markets is a good thing, and we promote that. As I said, we promote that elsewhere in the antitrust laws. So there just may be a difference here. I don't know if you want to reply, but I'd love to know if there is an individual study you can point to that says that trading markets, capital markets or futures markets, are better off if you only had, fewer actors.
Well, I'll leave that. I know that you have at least one academic coming up on a later panel. I'll leave him for the studies. Once again, I think...
Do I take it your answer is you are not familiar with any study?
No. Like you, though, I've been in the markets a long time. I'm pretty sure if you fractionalize markets, you get less liquidity, not more.
But why is that, Mr. Hyland, if you say fractionalized? We're not talking about putting one market in the U.S. and one market on the moon. We're talking about one market that has more participants or less participants. That's not fractionalizing a market. It's bringing to one market. Hopefully it's still a global market. These are pretty significant markets, but just more actors on that stage.
View USO or UNG not as an actor, but as a specialized form of exchange, where every day 30 or 40 million shares get traded that represent equitized versions of the futures. It's a highly efficient market, and the bigger it gets, the more efficient it becomes, the more liquid it becomes. If you were to take it and split it up 4 ways, you don't go from 40 million shares trading a day, where people, to 10 million each. You go to 5 million each.
What if I stipulate I'm not talking about exchange-traded funds? I'm trying to get your best expert, thought about markets and liquidity in markets.
If the question was if you had a limited number of participants who were, sole directors of their trading rather than the ETFs, which are really balancing these 40 million trades, then you're going to end up in a scenario that's going to look remarkably like iron ore, where there are 3 non-American companies that are the buyers, all Chinese, steel companies, and there are 3 non-American producers, and those 6 people decide the price of iron ore for everybody, and there's no real futures market. In a sense, if you follow some of the logic that some of the others have suggested, that's the direction you go. When people say, let's get rid of those evil speculators, let's just, as Commissioner Chilton said, let's turn that around. What you're really saying is the only people who should be allowed to trade crude oil are oil companies and Morgan Stanley? I'm not sure that's a good idea either. I think you want lots of participants. I've got 600,000 of them in my little sub-pocket, which funnel liquidity and price discovery and all these other things into the broader market. Split it up, you get less of that beneficial impact. Volatility will rise.
As I suspect, we still have a difference between us. But
yes.
Commissioner Chilton was, I think, not accurately quoted there. But in any event, Mr. Ciccio, I noticed, did you have a comment on our little back and forth here?
Yes, sir. Mr. Chairman, I do. As I said earlier, and I stand by it, my companies and my board of directors are made up of the top energy manager in these companies, and they represent the largest integrated steel companies, recycle steel companies, paper companies, commodity chemicals, fertilizers, specialty, food processors, you name it, brick, cement. These individuals will tell you that prior to the CFMA and prior to ETFs, the markets work just fine. And we don't need, the market works better it worked better without them. I think that if there were we no longer had ETFs, the market would work just fine. We support the idea that multiple players are participating in this market with transactions that are tied to the commodity is what makes this market a great market.
Thank you. I have no further questions. Commissioner Dunn.
Thank you. First, I want to thank some great staffing that I've had here. The chairman has pointed out that I have been mispronouncing Mr. Ciccio's name. I apologize for that. On an earlier panel, John Lothian was here and gave us a hard time about how we pronounced his last name, and unfortunately John writes a newsletter, and he pointed out that I had used an M at the end of his name, and he asked how would I like that if he did the same to me. Doesn't work out with Dunn very well. The other great staffing from Jason Gizzarelli, who is the staff member that sits behind me here, pointed out when I said there were 6.6 billion trades, what I had inadvertently done was in the notes that he had given me on the trading that takes place, there's 2.8 billion in futures and 5.12 million in options, and the total he wrote down was $3.3 billion. And in my exuberance, I added all three figures, and so I doubled it. So it is only $3.3 billion, but almost 11% of that is in energy, and is still a large number. Mr. Hyland, in your testimony, you indicate that the CFT staff has granted no action letters to two index-based funds, and you said that you thought we ought to go ahead and codify that and also extend it to positions to single commodity tracking funds or the funds itself. I understand what you're recommending here, but my point is that this commission, as a lot of commissions do things on a shorthand method, sometimes by no action caveat. And I have trouble with that because oftentimes that is interplay that goes on between commission staff and the person or entity that asks for that no action letter. I think you make an excellent suggestion that it ought to be codified. That, to me, means rulemaking through the Administrative Procedure Act that would allow all of the participants that may be affected by this an opportunity to have insight and make comment on that. Does the panel feel that this is a better way? And Senator Sanders, was here, was very adamant about what we ought to be doing with no action letters. So could I hear from the panel on that?
Yes, sir. We think that would be a terrific step forward.
The same.
I would agree. Commissioner Chilton had raised the issue of do there need to be more categories. Let's be blunt. The current setup is pretty outdated. It never envisioned that there would be swap dealers. I'm not a swap dealer, but I think there probably should be codified rules for them that distinguish them from both, speculators/investors and from commercial participants. They should have their own rules. They should have a brand new set of reporting requirements. I think there should be a separate designation for those that are pass-through vehicles like ourselves. I think it's long overdue to really kind of bring this setup. So we would absolutely agree that that it needs to be brought into the 21st century.
Thank you, Commissioner Dunn. No.
Just briefly, and thank you for that. So, Mr. Hyland, you said, I think in your testimony, that you're highly regulated. I mean, how does that impact you on a daily or weekly basis? And I mean, the accountability levels don't appear to be regulating you, right?
Well, we're subject to them. So, I mean, I've had people say, we're not subject to position limits. We're not subject to accountability. We're subject to them. Whether the exchanges...
But they're not enforced.
Well, that's discretion that the CFTC has granted the exchanges, and the exchanges, I think, have looked at our flow through nature and have heretofore not seen the issue that perhaps others have. I mean, I'm not going to badmouth the exchanges. They might get mad at me. But it's just the way it is.
What I'm curious about is... I'm sorry to interrupt, but what I'm curious about is, so if you set up different categories, and I agree with you, I think it's outdated and we need to look at things differently. But how would you develop a limit if we decided to develop sort of a hard limit for ETFs? I mean, you say that they're not impacting, so maybe your answer is there is no limit. Everybody else has a limit, but not us.
I like that idea.
Yeah, I thought you
It comes back to the overarching question, and I think it's probably may also be similar to the issue with swap dealers, who are essentially flow through. They have people on the other side of the swap. So I think you really need to be looking at them, and with us, you really need to be looking at our shareholders, and you need to change the rules to make that permissible The real ultimate question is based on actual hard evidence. What percentage of the total market, will you conclude can safely be held in aggregate by passive indexers? And that number, could be a number anywhere from 20% to 90%. And you can talk to the SEC about how they feel about S&P 500 index funds. Once you've got that worked out, I then think you have to decide how you envision this aggregate position being parceled out among one or multiple players, or do you just let the market decide? Because the market's preference is one big player because there's more liquidity that way. That's why ETFs invariably end up in any given sector, stocks, bonds, commodities, you end up with one big player and several small players because everybody wants to trade in the big swimming pool. Nobody wants to trade in the wading pool. You have to decide whether you want to let the market determine that or whether you want to impose something by fiat.
Thank you. Your testimony has actually been very helpful. All of you, but your testimony has been helpful, Mr. Hyland. I did want to sort of clarify what I was saying earlier. You sort of tried to paraphrase me, but that I'm not suggesting that we only need commercials in these markets. I think we need all players. This commission has never been about saying you're not tall enough to ride, but we may have said you have to go with an adult, or we have to put certain sidebars on the trading. And so, speculation isn't a four-letter word, and people want to do it. They should be free to do it. But from my personal perspective, I'm just concerned that there is an unintended consequence of the aggregate long-only or passive speculation. And I'm not suggesting that it is the driving and it's the only force there, but as I said earlier to Mr. Graham, even just a little bit can have a huge impact on industries or on our economy, and it's our job to look out for this, and hopefully we're going to get it right. So I thank you all.
I thank our panelists, and I apologize just because Mr. Hyland, I didn't know if you wanted to clarify. The last thing you said about the exchanges, just because you're in a public hearing right here, did you want to clarify what the exchanges, there's two of them that you trade on, I know, ICE and NYMEX, have said to you about position limits or your size on each of their respective markets?
No. I mean,
no, you
our general comment was that obviously there are position limits which are, under the current rules, not really applicable to us. We never hold far enough into them. There are accountability limits. We have discussions with the exchanges on these topics. Some people have represented that somehow we're not subject to them. We are subject to them, but it's at their discretion. And obviously we have ongoing discussions. What the actual nature of those discussions are, we wouldn't publicly comment on because it has the potential of unintended consequences. I'm sure the exchanges would feel the same.
All right. I thank all of our witnesses, and if our next panel is available, I think we're going to go into that next panel, and I thank all of you again for this very helpful explanation of the markets and your views.
Testing 1, 2, 3. Test 1, 2, 3. Testing 1, 2, 3. CTFC test.
We're going to try to get this going. We have Mr. Chambers, we have Mr. Arnold. Jason, do you know? We'll start. I thank you. I just want to ask if it's possible, just particularly for Commissioner Summers, if these charts could be taken down right now, and then whomever's, I don't know whose charts these are. So when we do it, but it just, I think Commissioner Summers is going to have a little difficulty seeing. So we'll find a way to accommodate it just as it goes. I thank you again. I thank our witnesses and for your patience. We've got this little green light system over here if you watch it, and if you've submitted some very detailed and expert testimony, but if you can try to give the toppers and summarize it, it'd be great in 5 minutes, and then we'll try to keep ourselves to that same discipline. But Mr. Chambers?
Mr. Chairman and fellow commissioners, thank you for the opportunity to testify today.
You might want to move the mic a little closer.
Okay.
Thank you.
I'm Elliot Chambers, Corporate Finance Manager for Chesapeake Energy Corporation. In that capacity, I am responsible for Chesapeake's risk management activities, including our use of over-the-counter or OTC derivatives. I'd like to begin by saying that Chesapeake Energy Corporation appreciates and encourages regulatory efforts to prevent excessive market speculation. As an end user that extensively utilizes OTC commodity derivatives as a vital risk management tool, we strongly support increased transparency, accountability, and market integrity. Chesapeake is the most active explorer for and the largest producer of U.S. natural gas. As such, we play a significant role in helping enhance America's energy independence. Notably, we reinvest 100% of our free cash flow directly into finding and producing clean-burning natural gas right here in the United States. With average daily natural gas production of approximately 2.2 billion cubic feet per day, or about 3.5% of total U.S. production, Chesapeake Energy's industry-leading efforts have helped the nation achieve extraordinary growth in natural gas production and reserves. Currently, Chesapeake has approximately 12.5 trillion cubic feet equivalent of proved reserves and an inventory of over 36,000 net drilling locations. In short, we have a lot of natural gas to produce. One of the reasons we are here today is because commodity prices can be extremely volatile, with natural gas being no exception. For example, on June 30, 2008, the NYMEX natural gas spot price was approximately $13 per MMBTU. As of Friday, July 31, 2009, that price is approximately $3.60, representing a 72% drop. Given such market volatility in our active exploration and production program, we heavily utilize risk management tools such as OTC derivatives to provide cash flow certainty while never creating additional exposure through speculation. Without the benefit of stability in our cash flow, whether we drill one additional well or develop a new potential gas field becomes a very problematic decision. A prime example that our risk management strategy helps enhance U.S. energy independence can be seen with our discovery and announcement of the Haynesville Shale natural gas play in March of 2008. The Haynesville Shale in Louisiana and Texas is possibly the largest natural gas field discovered in North America and is estimated to hold 245 trillion cubic feet of natural gas, or approximately 10 years of U.S. consumption at current levels. Chesapeake appreciates and supports the efforts of the CFTC to help make U.S. markets transparent, effective, and efficient. We also believe the Commission's concerns about excessive speculation in the commodity markets are certainly worthy of analysis and discussion. However, our concerns around excessive speculation differ in many cases to what has been discussed in the media and by consumers of commodities. We do not agree that commodity prices increased last year solely because of speculative hedge positions. Instead, we believe basic economic principles of supply and demand served as the main cause of prices increasing and subsequently decreasing. With respect to the focus of this hearing today, Chesapeake has serious concerns that position limits on energy futures and a more restrictive application of hedge exemptions could negatively impact our risk management efforts. These concerns are primarily focused on reduced market liquidity and related price instability. Chesapeake is not specifically opposed to position limits, but we do have concerns that if the limits are too low, it will remove vital liquidity from the marketplace. For the same reasons that Chesapeake is not actively selling our production forward at currently depressed prices, we cannot count on purchasers of natural gas to make a market for us when prices increase and we want to hedge. Thus, if too low of a contract position limit is implemented, we believe it will significantly dry up liquidity needed for producers to protect themselves. Chesapeake also has concerns regarding removing hedge exemptions for swap dealers. Without swap dealers, Chesapeake's risk management program would not be possible. Typically, when we place a hedge with a swap dealer, they quickly offload the risk by entering into an offsetting position, thus running a balanced derivative book. This is a vital risk management activity. We believe that both sides of this equation should be exempt from position limits since our activities are inherently risk-reducing. I appreciate the opportunity to speak here today and want to reiterate that Chesapeake is supportive of your efforts. At the same time, as a company that uses risk management tools to responsibly manage our core business of finding and producing natural gas, stringent position limits and a more restrictive hedge exemptions could significantly hurt our ability to continue protecting our company. In summary, if producers like Chesapeake cannot mitigate commodity price risk, then we will be forced to reduce drilling, which will reduce our nation's supply of clean, affordable American natural gas. A reduction in the supply of natural gas will put upward pressure on prices paid by American consumers and weaken our nation's energy independence efforts. We look forward to continuing to work together to address these important issues. Again, thank you, Mr. Chairman and fellow commissioners.
Thank you, Mr. Chambers. You live within the light limit. That was very helpful. If you could help me just so I pronounce your name.
It's Verlegger.
Verlegger.
There's a leg in the middle.
All right, Verlegger. Thank you.
Thank you, Mr. Commissioner. I've been studying and writing on energy for 35 years. As an official in the Treasury Department in the Carter administration, I played a critical role in the removal of price controls, and I was an author of the windfall profits tax, along with others who now decline to claim credit. At Drexel Burnham, I played a major role in the creation of the crude oil futures markets. I have written and worked on energy commodity markets for 3 decades. In that period, I've observed the great success in the commodity industry in breaking the control over the energy market once held by OPEC and the integrated oil companies. I believe consumers have reaped billions of dollars in benefits. I'm going to make 5 points today. First, the price increase from August 2007 to July 2008 was caused by a shortage of light sweet crude. Passive investors and speculators played no role in the price increase. The price increase was caused by the fall in output in Nigeria, the policies of the Bush administration related to the Strategic Reserve, and new environmental regulations introduced by the EU. The price collapse started the week DOE stopped filling the SPR following the order from Congress. Coincidence? I think not. I saw the problem coming and wrote about it in 2006. I testified to Congress in December 2007 this was coming. I was right. The IEA this June vindicated my views. I attached to my testimony after working with the IEA the price section which described in detail what happened. Second, flows of cash into the ICE and NYMEX light sweet crude contract have no impact on price changes in the spot crude prices. I have developed data on the cash flow in and out day by day into these 2 contracts. If there were an influence, one would observe on the left hand, my left, your right, this graph, you would see as the percent change in investment, percent change in prices.
Let me just see. Is there a way that they can put that on our screen? Thank you.
Okay. They all lie on that straight line. In fact, if you look to the next graph on the hypothetical relationship, the points are all over the place. The correlation is 0. You have to go to the 4th decimal place to find a point. There is no influence between cash flow into or out of the WTI contracts, this is a 1,000 observation, and the change price. Third, contrary to the suggestions of those who have not examined the data, passive investment in oil as a commodity exerts a stabilizing force on prices. Portfolio managers, as we heard, seem to sell as prices are rising while buying when prices fall. Evidence is on this 3rd graph on my right. The oil price is graphed in yellow on the right. The number of contracts held by the index funds is calculated, derived from CFTC data, is shown on the left. There is a strong countercyclical view. This countercyclical view is reinforced by the next graph, which shows that the change in WTI prices versus the percent change in open interest moves in a countercyclical fashion. That is, as prices rise, we see liquidation. This is a stabilizing force. Fourth, investment in commodities promotes inventory accumulation. Inventory accumulation has been a goal of those interested in energy security for 3 decades. In the last year, we've begun to see large accumulation of private stocks. These stocks, as the IEA points out, do not represent speculative stocks because they're hedged. We are seeing what happens in the grain markets for 100 years, what's been written by many. They are private stocks which add to the buffer in case of emergency. As you can see from this last figure, world inventories are now nearing record levels. Finally, I would argue that these markets are an essential component to continued development of oil and gas reserves in a competitive energy sector. Dependence on OPEC and integrated oil companies has been reduced by the entry of small firms. These firms continue to develop new reserves, and to do so, they require the ability to hedge. They hedge to the financial institutions such as J.P. Morgan. And as Ms. Masters pointed out last week in your hearings, these banks book together the positions, taking as security values of assets which rise and fall with prices. Imposition of position limits on banks or increased margin requirements on E&P firms will make it more costly and more difficult for firms in the E&P business. Thus, I strongly urge the Commission not to impose limits on these parties. The effect of such limits is really the effect of capitulation to OPEC. I strongly encourage the Commission not to impose position limits on index traders as respects energy market. I'll leave out the agricultural markets, they're different. Imposition of such limits could reduce the stabilizing impact of these investors. Prices could fall, causing reduced investment. The fall in prices would cause less to be invested in both oil and gas and alternatives. We would fall behind in our efforts to develop alternatives. Again, the consequence would be greater dependence on OPEC. I strongly encourage you not to capitulate to OPEC. Thank you.
Thank you, Mr. Verlager. And just one, Mr. Arnold, 1 minute. All right. Thank you, Doug.
Thank you, Chairman Gensler, distinguished commissioners, and staff of the CFTC. Thank you for the opportunity to appear before you today. My name is John Arnold, and I run a commodity-focused hedge fund named Centaurus Energy. We are active in a variety of businesses and have over 70 employees in 8 cities. Our primary focus is financial trading of North American natural gas. We share the Commission's goals of promoting efficiency, transparency, and integrity in the energy markets. We rely almost exclusively on fundamental analysis to guide our trading strategies. As such, we depend on a market that is governed by supply and demand and that produces fair prices. Each market has unique characteristics and demands a customized regulatory framework. Today, I will speak to you specifically about natural gas. The challenge the Commission faces is how to temper unnecessary volatility and promote transparency without damaging a market that is generally robust and well-functioning. I would like to share with the Commission my views on the factors that it should consider in designing and managing an effective limit structure for the natural gas market. In that regard, I propose the following. First, the Commission should impose hard limits on physical natural gas futures as they approach expiry. The expiration month limit should decrease in stair-step fashion at regular intervals as expiration approaches. No hedge exemptions to these limits should be granted to any party. Second, the Commission should consider replacing accountability levels with hard limits on the forward physical natural gas futures based on a maximum positions in any 1 month. There should be no all-month limit. Finally, the Commission should have transparency and oversight into all financially settled contract positions on exchange and over the counter, but should not impose hard limits on financial contracts. Like any market, natural gas needs rules to ensure fairness and to safeguard its participants from abuse. But, as is also true of any other market, the wrong regulations can be just as harmful as no regulation at all. On June 5th, 2 months prior to these hearings, the NYMEX amended its rules to establish hard limits on all financially settled natural gas contracts, effective next month with the expiration of the October contract. If allowed to take effect as currently structured, the new NYMEX limits will have a range of detrimental effects on the market, including pushing trading from exchanges to the less efficient and less transparent over-the-counter markets, increasing volatility, reducing liquidity, especially during bid week, and increasing costs for commercial hedgers. We already have seen traders start to move positions over the counter in anticipation of this rule. I urge the Commission to intervene immediately to take control of the limit-setting process and to suspend or rescind the new NYMEX rules until the Commission can implement a more appropriate regulatory framework. In these hearings and several other recent meetings, the Commission has received a great deal of input regarding limits and exemptions. I encourage the Commission to take a considered, reasonable approach to the issue rather than allowing each exchange to adopt discrete regulations that are ineffective, harmful to market efficiency, and likely inconsistent with the Commission's goals. I hope the resulting structure will promote a well-functioning market that continues to allow participants to effectively manage risk. I thank Chairman Gensler and the Commissioners for the opportunity to share my thoughts.
I thank all our witnesses. I found as I was digging into each of your testimonies, and we've got a great panel of 9 witnesses today, and we had terrific last week, but you had such varied things. I could myself probably go 3 panels with any one of you, so I apologize in advance if I don't get to all my questions. But Mr. Arnold, if I could just start with you. And it's going to get a little technical, but you suggest with regard to setting hard limits in the spot month, and I take it then you would also have hard limits, and no exemptions from that, is that right? And then you would also have limits on any deferred month, but not a combined month regime. And I just thought I'd like to understand how you would, why the first and not the latter?
Sure. I think the physical futures contract is vital to the industry. It's used as a benchmark both to settle financial trades as well as privately negotiated transactions with physical gas. The deferred contracts are used as a price discovery mechanism. The problem with having limits on the combined position is that you're reducing liquidity and increasing transaction costs of the commercial hedger who's trying to access the back of the curve. So if you put a total limit on the speculative community, you're incentivizing the large speculator to concentrate his liquidity in the front of the curve. Sure.
My mic's on now, sorry. So you're recommending setting position limits not only in the nearest or what's called the spot month, but also the deferred contracts moving forward.
So
the deferred physical contracts.
Right. So in my analysis, I think you should start with last day. Find out what's the appropriate limit to have on the last day that meets all commercial needs. Right? Then work from a stair step backwards. Right now, the exchange only has hard limits on the physical futures in the last 3 days. I believe that limits need to exist prior to that point. There needs to be a stair-step approach that, as market enters bid week, that may involve hard limits on futures contracts in deferred months as well.
And when you say, but not on combined months, is that back to your other point in this testimony that you think there should not be limits on the financially settled contracts?
Right. I think whenever if you establish a limit on the combined positions, you're incentivizing the large speculator to concentrate my positions in the front of the curve that are naturally more volatile. And I am the large speculator is a natural liquidity provider in the back of the curve. If you try to put a limit upon the activities of any one individual trader, I think there's a natural tendency to move positions to the more volatile part of the curve, which is in the front.
You mean the liquidity providers or the risk hedge funds are more likely to move to the volatile part because there's an old expression from Wall Street: volatility is our friend. It's where they can make more possible risk premium, risk profits.
I think the deferred part of the curve is naturally less volatile than the prompt month. Right? So if I'm confined on the amount of risk I can take, I don't want my limits in the deferred part of the curve that have very little volatility. Right? I'm going to move that position to the front. So whenever a producer is looking for a 5-year hedge, right, and they call up the bank and the bank approaches the market, I think you're reducing the liquidity and increasing the transaction cost of that market.
This is helpful. I know I'm going to try to sneak one more question in because it's just flashing green. Mr. Chambers, in terms of what you laid out, I think in my next round I'm going to talk about the over-the-counter derivatives part of it, which would be very helpful. But with regard to position limits, you said it was a little bit like, just don't set it too low. I mean, you're not opposed to it, but don't set it too low. Do you have a view as to what too low would be? If we were to move forward, this is a very relevant question now as to what level.
I think that at the end of the day, there needs to be more analysis, more information gathering to say what is the appropriate level. And that's the reason we were hesitant to put a level into our testimony. Listening to the various testimonies today and reading the testimonies from last week, there's widely divergent views. A lot of transparency, a lot more transparency coming from the marketplace to the CFTC would help arrive at the right decision. We said too low because if the limits are too low, frankly, it ruins our risk management efforts.
If it's not a competitive disadvantage, if you can answer the question, how many dealers do you deal with right now? What's the universe of swap dealers that you can hedge your risks with right now?
13, around between 10 and 15, depending on.
So between 10 and 15 is what you. All right, thank you, Commissioner Dunn.
Thank you very, very much, Mr. Chairman. I guess Mr. Verlager and Mr. Chambers, you both indicate that you think basic economic principles of supply and demand and also environmental regulations served as the main cause of price increase and subsequent declines. We're going to hear in the next panel Mr. Masters and Mr. Greenberger argue the exact opposite. Why are you correct and they are wrong?
From the information that we've been able to review, since the second quarter of 2008 to the second quarter of 2009, demand has dropped approximately 5%. Meanwhile, supply has increased approximately 2%. So the drop in natural gas prices seems evident to have been caused by a demand destruction, primarily coming from the industrial sector. On the flip side of that, going back to 2007 to 2008, there was more demand than supply, 0.5% to 1% greater. So that's what's driving our conclusions.
Sir, as I said, I laid out the case for it. The International Energy Agency, which is the arbitrator in this, has confirmed the case, and that's why I attached it, that it was the light sweet crude that created the constraint. There was a surplus of heavy crude last year in June that couldn't be sold when oil was at $147 a barrel because you couldn't make low sulfur diesel meeting European standards or our standards. For the first time last year, we were exporting diesel fuel to Europe because of their switch and the strength of the euro. This year, when prices were so low, something happened that has happened a few times in the history of commodity markets. Essentially, it became extremely profitable to build inventories. I had a case that I described in my written testimony on how J.P. Morgan has picked up something like 2 million barrels of heating oil. They bought it, they sold it in the forward market. According to Bloomberg, they are earning a return of anywhere between 50 and 100% on that return. Now, they can do this because they can borrow at 1 or 2% or 3% through the Federal Reserve Board, and the forward prices are there promoting inventory accumulation. Part of the reason we heard on the previous panel is that the forward prices are higher than cash prices because investors fear inflation. We saw the same thing in 1988 and 1999 when crude prices collapsed to 10. The market didn't expect crude prices to stay at 10, and they shouldn't. We need something like $40 to $50 a barrel, according to the engineers, to develop the oil. Chesapeake would say you need something, I suspect, around $3 or $4 a thousand cubic feet, maybe $6, to develop the natural gas. So the forward prices stay higher. And what happens when you have high forward prices and low cash prices, as this agency has known for 80 years, is that inventories accumulate. We have just seen the most rapid development of inventories, all of which are sold forward. And as the IEA says, this is not speculation. This is just plain transferring to the future. Now, I helped create the Strategic Petroleum Reserve in the Carter administration, and one of the things we were trying to do was build inventories because inventories are a buffer against price spikes, and we have just managed to get the first large private increase I think I've seen in 30 years. It is, so that is why the price. It's all fundamentals, and I've made a living, and I now teach at the University of Calgary, but writing on this and working with companies trying to take advantage of market advantages. This is cash and carry. This is how Cargill, the great grain company, became so large from nothing. It's just buying when the forward price is there.
In my agricultural parlance, then, it's the cost to carry.
It's cost of carry. I've read it as cash and carry. There's a long literature. Jeffrey Williams at the University of California, Davis has written about this. It's what has happened. One of the great things that's happened over the last 20 years is we've applied all the things we learned in agricultural economics to energy markets. They're more competitive and the consumer benefits.
That would indicate why, Mr. Chambers, for you, it's so important to understand what your break-evens are.
That's correct. We've spent a lot of time analyzing our cost to find and produce our gas, and that's why we pay a lot of attention to where we can layer in our hedges to affect our risk management efforts.
That's right. Commissioner Dunn, we will definitely have more rounds. Commissioner Summers.
Thank you, Mr. Chairman. Mr. Verlager, I'm going to continue on with some of the interesting concepts that you have in your testimony. One of the things that you talk about in your written testimony is the concept of the missing long and how the index investor has filled in this role. If you could just talk about that for a minute.
Thank you, Commissioner Summers. When the oil market was first created and you looked at other commodity markets, one of the problems we had was, in general, there were firms that wanted to sell forward, such as Chesapeake, and there were very often no longs. But one exception was heating oil, where consumers in New England wanted to lock in their heating costs, and they were large enough consumers. The logical long is the gasoline market, and the Petroleum Marketing Practices Act essentially prevents that, because there is no way that a company like Shell can sell gasoline to the consumer like you can sell a phone card, because that would be telling an individual gasoline station what you can charge for gasoline. That's illegal. We didn't have Costco and Walmart. Costco and Walmart could do this now because they own their own business. But so essentially a large portion of the, if you think of a seesaw, the one side, we didn't have the end users the way we have the bakers, the millers, and other commodity markets that have made the grain markets work so well for 50 or 100 years. What's happened is that then the investment funds, first in 1990 and 1991, started coming in with Goldman Sachs and their first commodity index, and then working forward, created that long and essentially created the balance and then an imbalance to a certain extent, which has caused perhaps more inventory accumulation than some would like. But essentially we did not have any commercial end users, because I as a gasoline consumer or you as a gasoline consumer cannot be offered the opportunity to lock in our gasoline prices under the current legislative situation we have.
Thank you for that explanation. I have a couple of questions from Mr. Arnold on his testimony, and specifically just to clarify the NYMEX rules amendment that you are asking to be rescinded. I think if I understood you correctly, you talk about how the unintended consequence of that would be for those positions to move OTC and move off exchange.
Correct. I think that's the first response by the industry is to move positions over the counter. We've already seen it start.
Because there would not be those hard limits imposed.
Exactly.
So if one of your other suggestions is that we don't impose limits on the OTC market. Wouldn't that have the same effect? If we're imposing the hard limits on the physically delivered contract and not the OTC market, will we see some migration of positions from exchange to the OTC market?
No, I think if you maintain the positions and strengthen the position limits on the physical futures contract, that business stays on the exchange. Right? The question is, where does the financial hedging and the financial trading end up? Is it over the counter or is it exchange? I think there's been a movement by the industry over the past 10 years to put this onto the exchange. People like the credit intermediation that the exchange brings. Right? 98% of our positions are on exchange for that reason. Right? The NYMEX rules run counter to that industry trend and try to move that business back off the exchange. But I think the physical futures contract is going to maintain on exchange.
Help me, just to clarify, help me understand that, because they're two separate reasons for conducting the business. There's different rules that should apply.
The physical futures contract and the financial contract serve different purposes. Right? The physical futures contract helps to manage physical exposures in the industry. It also creates the benchmark where there's industry indifference on expiration at that price, where the supply and demand of physical gas for the following month meet. And so the industry is very comfortable using that as the benchmark. The financial contract is used for a number of reasons, but it's not for physical. It's used to hedge financial exposures in the industry. It's used for speculation. It's used to arbitrage. But these are two different products, and they have different purposes. The industry historically has used the physical futures contract as a proxy to hedge financial risks. And I think that creates a problem and creates excessive volatility in that physical futures contract. And that's why I propose we strengthen the position limits on the physical futures contract to decrease that excessive volatility.
Thank you.
Thank you, Commissioner Summers. Commissioner Chilton.
Thanks, Mr. Chairman. A while back, I talked about people talking past each other, and another observation is that it's a common debating tactic to label people and put people in a certain category. And Dr. Verlegger said that those who seek to impose position limits would be capitulating to OPEC, which is a little bit stronger than you said in your testimony, in your formal testimony. But I don't think any of us are going to be capitulating to OPEC, and I think it's an unfair categorization. And it reminded me, in talking about OPEC, we had an economist last week here talked a little bit about OPEC, and it made me think about these sovereign wealth funds. UAE has $627 billion in a sovereign wealth fund. Saudi Arabia, $431 billion. Don't think for a minute that they're not using some of that for OTC swaps on energy. So I don't want to unfairly categorize the doctor, but it seems to me that regulation, appropriate regulation of the OTC market makes some sense. Mr. Arnold, I really appreciate your testimony. In part, I was particularly interested. You said that you look at the market and you place bets if they are biased, and you ask yourselves to identify what's forcing the market to price a product in an unfair value, and then you get in and you try to push the price back to that value. Do you think that the prices we've seen over the last 2 years have been forced into an unfair value?
You have to draw the distinction between prompt month and expiration, which is kind of supply and demand of physical gas for the following month, and the forward curve. And there's been a lot of academic literature done about the forward curve is not the best price indicator of where those contracts are. It is supply and demand of forward price hedging. Right? At times, that differs from where I foresee fair value, and that's how I try to make money in the industry. Is I try to buy things whenever they're trading below what our analysis does show us to be fair value, and sell things whenever our analysis shows that the forward curve is higher than our analysis of fair value.
You said, Mr. Chambers, in your written testimony that you didn't believe that commodity prices of last year were due solely to speculation. I don't believe they were solely due to speculation either. But can you elaborate on that? Do you think that there was some part that was due to speculation?
Well, I think speculation had a role to play, but we would argue that that speculation is necessary for the fact that as prices increase, Chesapeake and other producers like ourselves that are already long the product will look to sell in the future. So we need that speculation on the other side to buy our production forward. So I think it does have an impact, but it's a positive one, and it helps us cap the price.
I'll try to get one more in, Mr. Chairman, and this isn't particularly for something that we're working on now, and I notice we have some congressional staff here, so maybe it will be helpful to them, maybe not. But you talk about clearing of OTC products and how you use your assets as collateral, and that if you didn't have that freed up capital, you wouldn't be able to explore, et cetera. Can you explain that a little bit more? Why would requiring clearing impact your business in a negative fashion?
In summary, it boils down to the end result of our strategy is to lock in cash. If we're to hedge out into the future and we are forced to clear, that creates a very big cash question near term for a long-term strategy. So there's a disconnect in and of itself. It really negates the whole point behind the strategy.
So your swaps are collateralized already. Mm-hmm. So and then you use that capital for whatever, research or exploration, et cetera. And so if you had to put up additional capital to clear, it would impact your ability to explore. Is that a fair?
Absolutely, and a perfect example of that is 2008 when natural gas prices were so high. We had been selling in the market actively because that price was above our break even. So we had a fairly substantial loss, mark-to-market loss, around June 30 of last year in excess of $6 billion. If we had to have posted that as collateral or on an exchange, cash collateralized that, frankly, we don't know if we would have been able to find that cash, number one, but it definitely would have impacted our drilling efforts.
Thank you.
Thank you, Commissioner Chilton, and I'm going to follow up on that very briefly in your testimony, Mr. Chambers, very helpful. With regard to posting of collateral, is it your position, though, that you think that posting something other than cash collateral, and this is the subject of over-the-counter derivatives, not position limits, but with regard to the administration's proposals and this commission's proposals as well to bring regulation over-the-counter derivatives, we've promoted use of centralized clearing, but also regulating the dealers for capital and margin. And in your testimony, you raised the issue of whether that has to be cash collateral or non-cash. I don't know if you saw Chairman Peterson and Chairman Frank's joint press conference last week where they actually, in a couple of pages of bullet points, said that they thought they would be moving forward to have the market regulators, the CFTC and SEC, able to write rules so they could accept non-cash collateral. Is your point of view sort of similar to what they were saying, or are you suggesting that there'd be no posting of collateral whatsoever?
I think that, Chesapeake's position on that would be that we are completely fine and supportive of posting collateral. It helps us achieve our aims. To the extent for that to be arbitrarily set, or maybe not arbitrarily, but for that to be set through regulatory means makes us a little concerned, because you could get to a much different answer than what we have today. Going back to whenever we owed over $6 billion and our mark-to-market on our hedge positions, we had around $11 billion worth of oil and gas properties pledged. It's a question mark whether a regulatory answer would have been $11 billion, $16 billion, $20 billion, $5 billion. It's a big question, and it does cause us some concern.
No, I appreciate it. I would hope that anything that Congress does in writing statute or what this commission or other commissions do wouldn't be arbitrary. But no, you're right. It would be important to get it right. You also mentioned in your testimony about customized versus standardized products. So if I can just address that, you don't need to respond. I've testified on this a number of times, and I'm a firm believer that we have tens of thousands of end users that need to still use risk management customized products in the marketplace for over-the-counter derivatives. But the only way to bring regulation is to regulate the dealers fully. The dealers would have to report all those trades and have business conduct standards and capital for both customized and standardized, and then we'd mandate moving the standardized product, not the customized, but the standardized products into clearing and centralized exchanges. You don't need to comment, but your testimony had raised that point, if you had any. Mr. Verlegger, in terms of your charts and so forth, and I think it was chart 6, I think it was one that was up here, but if I have the number wrong, I apologize. It really goes to sort of what I'll call the macro view of a market. You were looking at changes in total investment, and the word said total investment, to the change in prices. What I'm interested in is not what you researched here, which was interesting as well, but I'm interested in a micro market question, if I can borrow a phrase that you're probably more familiar with because you have the PhD and I don't. But about the structure of markets, and I'm also interested in Mr. Arnold's answer to this too, is if we look at liquidity in markets, if we look at the market integrity of how a market is structured, are we better off limiting the size, the maximum size of any one participant in the market?
I listened to your questions in the previous panel. You're absolutely correct. We would be better on liquidity and I think volatility if we had, say, 5 ETFs than 1 ETF, and the 5 ETFs each presumably would follow slightly different policies of how they rolled their positions rather than having a single ETF going forward. I've been a student of your reports for 20 years, and you look at the detailed reports and you see the number of firms and the percentages, and I've always wanted Herfindahl indices out of there so I could see the kind of a real measure of the whole stream of things. It's you're absolutely right. Put a position limit on, and if other ETFs enter the business because there's a position limit, it promotes more competition. Just as, and I apologize for